Welcome, dear aspirants, to Rungta IAS Academy. I am Professor Sharma.
And I am Professor Rao. Today, we're diving straight into a highly dynamic, high-probability topic for your General Studies Paper 3 Economy syllabus. We are decoding the steep depreciation of the Indian rupee. Let's get right into this explainer.
The rupee touching that 97 mark against the dollar? Well, it's not just a data point flashing on a trading terminal. It's a massive macroeconomic development.
Absolutely right, Professor Sharma. It's being driven by things like surging global oil prices and looming external inflation threats. For UPSC, you can't just skim the surface here. You really have to grasp the underlying mechanics.
Exactly. To anchor our whole discussion today, let's look at how the Commission frames this. Take a look at this standard mains question. Discuss the macroeconomic implications of a depreciating rupee. Should the RBI intervene? 15 marks, 250 words. Keep this exact question running in the back of your mind as we unpack the competing economic theories today. Your ultimate goal, mark my words, is to build a well-rounded, multidimensional answer.
Moving to Section 1, the policy debate, to intervene or not. We actually see a very sharp academic contrast here between two prominent schools of thought. On one hand, you have the free market view. This is championed by economists like Harvard professor Gita Gopinath. The argument is simple: let the rupee find its own natural level. Why? Because a weaker currency automatically fixes the current account deficit by making our exports much cheaper and globally competitive. True, but you absolutely have to balance that with Rahul Menon's interventionist counterargument. He points out the immediate danger of unabated imported inflation. If you just let depreciation go unchecked, the cost of everyday essential goods is going to skyrocket.
Section 2. Conceptual clarity. Weak versus falling rupee.
Now, aspirants, pay very close attention to this part, because conflating a weak rupee with a falling rupee is a classic conceptual trap. The UPSC examiners will spot it immediately.
Spot on. So what is the crucial distinction? A weak rupee means it's stable, just at a lower value. It does exactly what mainstream models predict. It curtails imports and boosts exports. But a falling rupee? That's completely different. That's an active downward trend.
Exactly. A consistently falling rupee literally destroys export demand. Think about it. Foreign buyers are just going to wait for better prices tomorrow. Meanwhile, our domestic importers start panicking. They front-load their purchases. It's kind of like the rush to buy petrol before a price hike, and that panic buying actually worsens the deficit in the short run.
And this distinction perfectly illustrates the real-world consequences. You must always link macroeconomic theory to the grassroots socio-economic impact. Rising import costs directly fuel domestic inflation. And who ultimately bears that brunt? It's a populace that's already navigating immense hardships. We are talking about reverse migration and real wage squeezes. This kind of empathetic, holistic linkage, that is exactly what fetches those extra marks in your mains answer.
Section 3. The culprit. Speculative capital flows.
When you look at the broader data, the rupee's current value is basically being hijacked by market sentiments rather than fundamental economic behavior. Exactly, we are witnessing massive speculative outflows of foreign institutional investments. Basically, investors are either doubting India's sustainable growth or they're just anticipating really low returns on Indian stocks. Furthermore, with foreign central banks signaling aggressive interest rate hikes, capital naturally just flees emerging markets. When currency depreciation is driven by this kind of sheer speculation, finding a natural equilibrium becomes incredibly difficult.
Section 4. Global precedents and exam strategy.
Now here's a pro tip to score high. Always substantiate your arguments with international precedents. Take this brilliant example from April. Professor Rao, Japanese Finance Minister Satsuki Katayama signaled decisive action in financial markets to maintain the yen. What does this show us? It demonstrates that even advanced, highly developed economies like Japan will actively intervene in markets to protect their currency from immense speculative forces. You can confidently cite this in your exam to argue that intervention is a globally recognized policy tool.
Finally, we leave you with this crucial personality test prompt to ponder. How should India balance its reliance on foreign capital with long-term macroeconomic stability?
It really is the critical question of striking the right balance in a volatile global economy. Study hard, dear aspirants. Make sure your conceptual clarity is rock solid and structure your answers well. We will see you in the next explainer.